So let's jump to step 3 here, which is analyzing the individual investments. So one thing I gotta really stress here is we have to use today's numbers. We have to use current numbers. Many people get anchored to the purchase numbers, their past numbers, their buy numbers. Now, while that's a very important data point, it is one data point. And after we are analyzing properties, when we buy it, and after that first year or two, those numbers become less and less important. So using current numbers is by far so important. So I can tell you, the most common mistake I see from landlords is that most have under market rents. That is the number one issue I have. And this is, pretty common around many markets because we've just had, aside from like all the crazy appreciation, we've also had, pretty high rental growth as well. And so unless you're out there raising your rents everywhere, a lot of times people are under market their rents. Now, of course, there's all sorts of situations where you have a great long-term tenant. So you're charging, you're not raising the rents to market because it's a great win-win situation. I'm just saying, this is something you want to be aware of, and you have to figure out, hey, what are the pros and cons of everything? So that's just a very common issue I see is a lot of landlords, and I've been guilty of this myself, that have under market rents. And I'm not saying it's bad or good if you have a great tenant in there and you're charging them below market rent, but it is going to affect the numbers we look into Property Llama. And when it comes to like getting rents and current property values, I'd highly recommend you go out there and connect with your agent. They can help you figure out the best, the current property value, because the local agent is usually has the most expertise in your local market. And they can connect you with a property manager or use various tools to go out there and also help you figure out what the best rents are for your portfolio as well. All right, so let's come down here and start going through the properties on the portfolio. So I have 4 properties in here. I have 2 single-family rentals. That's what SFR stands for. I have a fourplex rental and I have a condo rental. So I'm going to start with SFR rental 1. And I'll tell you the process I do for all these. I won't do it for every single one of these right now just for the sake of time. But I'm going to give you a high-level introductory analysis here on reviewing these. So I'm going to open this. I like to open it in a new tab because I get the more detailed view. And okay, let's look at this property. It's worth about $650,000. I have about $450,000 in equity. And let's see, this is a property that I purchased in 2015 for about $300,000. And over the last, 8-9 years, it has about doubled in value. I'm sure fellow landlords can, relate to that. It's a great problem to have. And I'm using air quotes there. It's a great problem to have. But looking down here, I have a very low return equity. I'm about 6.5%. And these green numbers, return equity, loan to value, and cap rate, these are the 3 most important numbers to me when I analyze properties. It may not be the most important to you, but that is how my brain is wired. Return equity, so for all the money in here, this $30,000 a year I'm making, $30,000 divided by 450 is about 6.5% return on equity. So if I took that $450,000, and don't worry about transaction costs and taxes right now, but if I took that and invested in the stock market, well, I should make between 8 to 10% historically speaking. So I personally like to see a higher return on my equity. Plus, if I need to go out there and accumulate more properties, I'm in my growth mode, a 6.5% return just does not excite me, nor is it going to get me to my goal. So this property has a 30% loan to value. So that's 198 divided by 650 is about 30%. So again, I'm a lower leverage because I've been paying down the debt, and also the price has appreciated quite a bit. Like I said, I'm not a big fan of cash-on-cash return as we're doing a portfolio analysis because it's kind of like a meaningless metric, and I often think it's a red herring and gets people focused on just cash flow. So I'm not going to spend much time on that. Actually, I'll spend no time on that. I'm going to jump straight over to cap rate. And this is where having current numbers is so important. Cap rate is saying, hey, what's my net operating income or my future retirement cash flow divided by my equity, $452,000, gives me, not the equity, but by the current value. So it's 15,000 NOI divided by the current value gives me a 2.33% cap rate. Now realize that the cap rates are going to depend a lot on your market, like your local market, like investing in California versus Denver versus Ohio. We all have different market conditions and we all have different returns. So the market has a big impact, and also, the type of property. A Class A property tends to have a lower return because it tends to be a nicer, safer asset with less headaches than a Class D or C property where you're dealing with just more headaches and more tenant turnover typically. So you should get more money for that. So this does help you determine, risk reward. But this is something that you really need to talk to your real estate team about and figure out what cap rates make sense in the current market conditions and where you're investing. Now, a 2.3% cap rate is incredibly low. And this is due to the fact that we've had so much appreciation, but also what I said earlier in a previous slide, my rent is really, really low on this property. For a property that's $650,000 here in Denver, we're typically seeing a $3,000 plus rent. So I'm going to show you one thing, just how this starts affecting this. We can play some what if scenarios. Well, hey, what if you came in here and increased the rents? Let's get up to market rent. And I'm just kind of making up these rent numbers right now, but I'll get you close to ballpark. And my PM says, hey, this is you could probably rent for about $3,400 a month. So I'll come back here, I'll save it. And then what this does is this updates the individual asset and also goes back and updates that global overview. Well, now my cap rate went from a 2.3% to a 4.1%. You can also see my return on equity went up from 6.5% to 9%. Why? Because I increased my cash flow here. So sometimes for many landlords, always check your rents. And for a lot of us, we just need to go out there and increase our rents to understand how that property is performing. So you can come down here, and I won't go through all this, but you can come down here and make sure that your expenses are accurate and up to date. Property taxes, insurance, oftentimes, they go up every year, every couple of years, depending on where you live or what's going on with the local insurance market. But make sure this stuff is up to date. And I would recommend too, you come back and review maintenance as well. Like, how much have you spent on the property? Do you have any big CapEx items coming up? Like, let's come back and make sure we have fairly accurate numbers here. Doesn't need to be perfect, but get it good enough so we can have a pretty good view on how that property is performing. So I'd come down here and just look at the numbers here. But from a high level, this is usually what I focus on because I want to see if I'm up to current rents and how is this property performing. Now I would go through, and I'm going to go back, and we would just go through and do this for all the properties we have. Hey, how is this performing? Let's talk about it. How long have you owned it? And also, we can't capture this through numbers, but what's the emotional aspect? What's the headache of it? Is this property a complete winner for you? Or is it one you don't like? Or has it just been one of those man, it looked good on paper, but after a couple years owning, it's a pain in the butt. And that happens. We're not going to pick 100% of the winners. I don't. I'm actually selling a property because it just does not fit with my current profile. Again, not right or wrong. It's just based on where I'm at. A couple years ago, it made perfect sense. But now I'm like, you know what? My life has changed. This property takes a lot more time and bandwidth than I would like to invest into it. I'm going to sell it and put that money into a lower headache rental property so I can go out there and get the return that's the best fit for me and my goals and my portfolio. So we come down here, again, just review every single property. I'm not going to do that in detail now for the sake of time. And you'll learn a lot as you do this yourself with your real estate coach.